Well, there's one thing we have to do in business, and that's pay taxes. Well, welcome to another episode of your Not So Normal CFO. So today we're going to talk about taxes, but we're not going to talk about sales tax. We're not going to talk about payroll tax. We're going to be talking about your annual tax return that's usually prepared by your accountant, your outside accountant, whether it be a CPA or somebody else, and then submitted to the IRS. You'd be surprised how many times everybody gets crazy during tax season, as do I. Return is due March 15th, and March 14th at 5 o'clock it's plopped on the business owner's desk and say, here, sign, we got to file tomorrow. Well, I don't subscribe to that theory. I don't think it's healthy. I think it's something that as a business owner you need to take interest in. If your company is large enough to have a controller or a CFO, then guess what? They should be reviewing this in detail before it goes out. So I'm going to give you a little tips and tricks on how to prepare to file your annual tax return for your company. So you're going to close your books for 2022 as quickly as possible. Why? Because the sooner you do it, the more time the outside accountant has to prepare the tax return, and the more time you have to review your numbers, make changes, and also maybe sit down and have discussions with your outside accountant as to different things that maybe you could do to take advantage of what's available in the tax code. Be very careful when you're doing this to review your year-end cutoffs, because sales ends December 31st at midnight. And if it's service, it's based on when the service was performed. And if it's a product, it depends on when title transfers to the customer. So I know that people like to go out New Year's Eve, and in my experience, I had a situation where somebody wanted to go out to a party. So what they did is loaded the tractor trailer. The driver showed up the next morning to pull out the tractor trailer. And instead of dating the bill of lading December 31st, he dated it January 1st, because that's the day he drove it away. Well, guess what? That becomes a 2023 sale, not a 2022 sale. So you have to be careful with your sales cutoffs. Another thing that cuts off at December 31st is your inventory. So you have to either take a physical count, or your books and records might be sufficient for you to know what your inventory is on a perpetual basis. But you have to make sure that your ins and outs cut off December 31st at the end of business on that day. So that's another critical cutoff that can increase profits for tax purposes, decrease profits for tax purposes, and therefore you want to make sure it's correct. And the last one is your payable. When did I owe it? Because we all know that when it comes to different things that you pay for in your business, it's not easy to determine when did I really owe this money. For example, you ordered merchandise on December 26th. Merchandise was shipped December 26th. The vendor invoiced you December 26th, but you didn't receive it till January 3rd. So therefore, at December 31st, you do not owe that vendor money. So you have to be very careful about your cutoffs as it relates to when do I owe this money. And again, this is all based on size of company, complexity of company, and complexity of staff that are able to handle these type of issues. But here's some tips and tricks just to keep you aware of what goes on in your company at the very end of the year that affects your annual filing of taxes. The results that we come up with should be reviewed with management if management is not reporting it. If you have a controller, a bookkeeper, a CFO, an outside service, your final numbers should be gone over with management before they're submitted to the external accountant to file your taxes, because you need to know before you go. So therefore, a good review is very important at the end of the year. It also gives you a heads up as to if you're budgeting for the following year, you may see things that require a change in budget that you had prepared for the following year. Something happened and you didn't notice it during the budget process, but now you do, so therefore you want to just tweak your budget a little bit because you didn't realize this cost went up, or you didn't realize this cost went down, or maybe the cost went away completely. So you may want to tweak your budget based on what you find on your year-end review. Now, when it comes to preparing a tax return, it's not as simple as here's the numbers, go do it. So you should be sitting down with your accountant and your internal staff to find out what additional information are you going to need other than a balance sheet, P&L, and trial balance? Well, you may need to know detailed transactions as it relates to the owner's or partner's accounts, depending on which type of form you're filing with the IRS. If it's an S Corp or a partnership, you also need to make sure that there's no special allocations, because the tax software will allocate everything by ownership, and in some cases there may be special allocations that have to be handled differently. So again, sit down, have the discussion, make sure they get the right information the first time. It's going to save you time and money, because most of us preparing tax returns are doing it by the hour. Non-deductible items. What did I do during the year where I spent money that's not tax deductible? For example, coming January 1st, 2023, only 50% of your business meals are going to be deductible, where for the last couple of years, we've been deducting 100% of our business meals. So that's, if you spend $100,000 on meals, and plenty companies do, only $50,000 is going to be deductible instead of $100,000. So that's $50,000 that you spent out of your pocket, and you're not getting any tax benefit for it. And then, of course, we have the pass-through items on partnerships and sub-S corporations having to do with medical insurance and the like. Be careful. Make sure you understand what each of these items are. Sit down with your outside accountant and make sure when information is transmitted, the right information is transmitted. And also remember, under no circumstances are political contributions deductible, because we always know that there's politicians around running with their hand out. So be careful about that also. Now the accountant goes out and prepares your return and then brings it back to you for signature, either electronically or physically, and he needs or she needs your signature to file that tax return. Well, before you put your signature on that piece of paper, it's very important to go through to make sure that what you believe should happen as far as taxable income, pass-through items, non-deductible items, is actually on your return the way you thought it would come out. And of course, some of the things I'm going to talk about now depend on the size of your company and the abilities of the staff that you have inside your company in the accounting and financial area. So the first thing you should do is reconcile your book income, what your P&L says, to your tax return. Because of the way items shift for various purposes, such as R&D credits and in 2023 the meals, and then medical insurance for partners and owners, it's not going to be exactly what your financial statement says. If your financial statement says you made $100,000, your tax return may say you made $60,000. But then you're going to have pass-through items that add on to your regular return. So you need to reconcile all of that. The ability to do that is usually not within the skill set of most owners, and hopefully there's somebody inside the company that you have who can do that. Review partner and owner accounts, because that's very important. That determines your tax basis for any capital transactions that may occur in the following year. So you want to make sure that your owner account is right or a partner's account is right, because if you're going to bring in additional partners and rearrange the stock, you don't want to have a taxable event, or you just want to make sure that if you do have a taxable event, that your account is stated correctly so that you pay the proper tax. Many times in the filing of annual tax returns, the state return will be different than the federal return because of state issues and laws. So make sure you understand that and try to reconcile from one to the other. And again, if you don't have the staff and you don't have the skill set, you should, as a serious owner, call in the outside accountant and say, explain this to me. Don't take the excuse that we're too busy. That's all part of the tax preparation. Because at the end of the day, it's your signature that's going on the return, and if anything is wrong, you're the one who's liable for any additional tax penalties and interest. And I also recommend, because of the many years I've been doing this and all the tragedies that I've seen, you should not only keep soft copies on your servers, you should also keep hard copies in a filing cabinet. Because things happen to servers. I don't care how many times you back up. Next thing you know, it's not compatible. You can't find it. It won't load. And on the other side, when you go into the filing cabinet, unless they're fireproof or waterproof, something can happen to that copy. So this way you have it both ways. Soft and hard copies every year for your tax returns. And even though after 7 years, you can get rid of the backup to your tax returns. I would never, ever throw the returns away. I graduated college in 1973. I have all my returns since 1974. You never know when you're going to need it and for what purpose. And it is a process that you're responsible for. I know your accountant does the work, but you're responsible for the return. So treat it carefully, take interest, learn about all the different nuances in and out of the return, and I think you'll have a very happy relationship with your accountant and a very happy relationship with the IRS and the various states that you may end up filing in. So that's it for today's episode, and we'll see you soon.